Afternoon to everyone. We welcome all the investors, fund managers, and analysts joining HNB PLC's investor update for 4Q and financial year 2025. With me here today, our Managing Director, Chief Executive Officer, Mr. Damit Pallapatha, our Chief Financial Officer, Ms. Anna Delage, and myself, Vimal Pera. So the lineup for the session today is of two parts. We'll have a prepared presentation on the key financial highlights for the financial year, which will be done by our Managing Director, followed by a Q&A session. You can use the chat option on the MST link to direct your questions, and we will respond to them within the time available to us. With that, I'll hand over the controls to MD to take you all through the presentation.
Thank you, Bimal. Good afternoon, everybody. I'm pleased to come in front of you and present the financials of 4Q as well as for financial year 2025. Let's first go through the presentation to get a view on how HNB has contributed and performed in 2025. If you look at the performance in a nutshell, first look at the key growth drivers that we have seen in 2025 in terms of assets, loans, deposits, and equity. But before going there, I need to maybe set a preamble. 2025 being a year which we have seen a significant loan growth across the industry. A lot of banks have recorded higher than average loan growth in any year. So we have seen that trend. However, at the same time, we have seen pressure on margins. We have seen squeezed margin in terms of loan books. Interest rates have kept low. We have seen low interest rate regime have put pressure on cost management as well as NIMs that were maintained by banks. Even though the NIMs have been very tight, banks have managed to grow the loan book, so the volumes have caught up, so that contributed a decent level of profitability across the industry. If you look at the total assets, HNB's market share has increased slightly from 9.4 to 9.6 compared to previous year. Nevertheless, the loan book has noted the sizable increase from almost 10% to 11%. I think that contributed to significantly aggressive loan growth that we have adopted. In terms of deposits, so we have seen once again incremental market share that we recorded from 9.5 to almost 10%, while the equity remain more or less the same levels in terms of market share for HNB. Moving on, if you look at the key ratios, as I mentioned at the beginning, we have seen pressure on the margins. So our margins may be slightly dropped from 5 plus to 4.6% in 2025. Cost income ratio, slight increase, but more or less remain flat, while interest rate margins, net interest margins coming down, that would have put little more pressure on the bottom line. Return on assets more or less remain same, 2 plus, and return on equity with the incremental loan growth that we have seen and maybe little tight, remained at 18% compared to the 19.85 that we maintained last year. Bank recorded exceptional asset quality in 2025, one of the best years that we had. It is imperative to mention it is not because of the loan book growth that we have recorded the best asset quality ratios, but we have seen our stage 3 portfolio in absolute terms came down at least 20%. So that shows the rigorous plans that the bank has implemented on recovery side, as well as the policy framework that we have revised and made it more robust in terms of underwriting, so which booked in better quality credits. Impairment of the stage 3 loan portfolio, impairment ratio has improved from 74 to 75, almost 76, making HNB one of the highest impairment coverage, stage 3 impairment ratio coverage banks in the industry. So we are considered when it comes to stage 3, even though there is a collateral cover, we consciously make sure that we are keeping impairment adequate. So in the event of uncertainty or event of unexpected, so we don't have volatility bringing into the P&L. Earning per share increased notably from 72.30 to 79.44 with the asset book growth. So our net assets per share increased once again notably. Interest yield is where the challenge leading to tighter NIMs, because interest rates kept low. The policy rates remain almost consistently at lower levels, and also AWPLR maintaining a very low level with least volatility. So we have seen interest yields compared to last year was lower, and at the same time it reflected in interest costs as well, which is once again reduced from 7.2 to 6% compared to previous year, because the interest rate remained comparatively lower. Our capital ratios remain very comfortable. So we have maybe 600 basis points plus in terms of total capital versus the regulatory requirement. So that gives us little bit of leeway what do we want to do in terms of excess capital we have that supports our expansions, growths, and how best we need to reach enhanced markets in terms of expansion that we are looking at. At the same time, whilst the capital is very strong, we also kept our liquidity ratio strong versus the 100% requirement. We were at 227%. So that tells us, even though the loan books have grown, we still have a decent level of excess liquidity with us, even to support further growth that we would have had opportunity to do. Moving on, if you look at where our key products have performed, some of those products have recorded exceptional growth. If you especially look at housing loans, after a very lull period, following the crisis, so we have seen housing loan portfolio improved or increased by 1/4, that is 25%. Overdrafts, once again, the leases, significant growth with the vehicle market opening with restrictions have been lifted, grown by 55%. That's the highest ever growth that we have recorded in the lease book in terms of percentage growth. Pawning portfolio once again recorded almost 45% growth. Credit card portfolio 25%, and similarly, most importantly, we have recorded CASA almost a little over 18%. The usual term deposit growth that we maintain over a period, maybe 10 to 12.5% almost, we have managed to maintain the term deposit growth rate over a period. But having said that, the accelerated asset growth, which is about 30% in general, has come through the significant portfolio growth recorded in the products that we have demonstrated. If you move on to the financial performance, in terms of interest income, given the fact that we have seen interest rates are settling at a lower levels than that of 2024, we have seen interest income has reduced slightly, whilst interest expense has reduced at a faster rate than the interest income, leaving the bank almost 5% growth in the net interest income. The loan book expanded by 355 billion, which is the highest growth in any particular year bank has recorded. in its history. So then 350 billion is a significant growth, almost 30%. Our deposits grew by 246 billion. Once again, highest ever growth that we have recorded in a particular year. So also the CASA deposits grow significantly, over 100 billion during the period, which is once again a significant achievement. NII for the group, if you look at the bank retained at 4.6, but if you consider the group, we have recorded 4.9% year-on-year increase. Whilst the interest rate margins kept very tight and challenging, so we have managed to cover some of the deficiencies through non-fund based income. If you look at overall net fee-based income, fee and commission-based income has increased almost by 30% or a little over 30%. So that has contributed immensely to cover any deficiencies or the tight NIMs that we have managed to navigate compared to 2024. Also, if you look at the total operating income compared to last year, taking into account both group on a group basis, recorded a significant change in 2025. Also, if you look at where this fee income has come from, so we have seen increased trade during 2024, especially taking into account the vehicle imports, as well as we have seen increased utilization on the credit cards. So that has given a little bit of an edge for the bank with a sizable credit card portfolio. And also we have seen increased transition to digital channels where e-banking and various other digital channels have been used by the customers. So that supports incremental fee income growth the bank has recorded. I just mentioned about the asset quality. I think bank has recorded one of the best in the industry asset qualities, where your net stage 3 ratio remain at 1.09% with the highest level stage 3 coverage ratio of 79%. If you look at asset quality movement over the last 4 quarters, that means from quarter 1 to quarter 4, so we have seen the absolute asset, the stage 3 ratio actually has shown a significant improvement, reflecting the efforts that the teams looking after the collection side as well as the recoveries, how rigorously that they have managed to resolve some of the tight or difficult exposures that the bank has exposed. If you look at sector-wise, so that also gives some indication of how the risks are distributed across. So we have seen our loan book is fairly decently distributed across. That means whatever that are coming to stage 3, it is not restricted to concentrated lending, which is a conscious decision and a robust policy framework that we maintain. So whatever that we contributed in terms of bringing in new credits to the balance sheet, so it is well dispersed. So then we believe going forward as well, this diversification and the dispersed risks will help the bank to maintain the required or better asset quality going forward. In terms of operational expenses, we have seen increase in operational expenses. So 20% increase is what we are seeing in operating expenses, specifically driven by personnel expenses. And also we saw the insurance costs have getting increased. One other factor is that when we saw credit card receivables have grown by 25% in my earlier slide, so that there are expenses related to that proportionately that we have seen increasing. So that are recorded in other expenses, which are mainly due to higher Visa and MasterCard related costs arising from the increased transactions volume. So that were given revenue as plus the expenses are recorded under other expenses. Cost income ratio slightly increased from 37.2 to 37.8. However, group TOI has it also contributed comparatively from 48.4 to 49.1 to in terms of cost to income at group level. In terms of profitability, look at group level. So we have seen 11% increase in the group level profitability. So the significant of that is 2024 contained profitability that are coming as a result of the ISB restructuring, which is not there in 2025. So that reflects the efforts that the bank has put in to increase the overall core banking profitability coming from the core banking operations. So the more than 11% increase that we have seen in numbers. So what is more significant is that without any one-off extraordinary items, so the bank and the group has managed to maintain and in fact increase its profitability through its cooperation. So this sets a very strong foundation for the bank and the group for the next few years to come. How do we want to navigate the challenges that are coming through? Because we have built a very sound foundation in terms of core banking product growth, what we have consciously done during 2025. If you look at the soundness indicators, liquidity coverage ratio versus the regulatory requirement of 100% for all currency, we are maintained at 227%. So only for rupees, it's almost close to 200% at 193.9%. Net stable funding ratio at 137% compared to the regulatory requirement of 100%. So capital, as I said, well above the requirements that were set by regulatory. So we have about 600 basis point excess compared to the regulatory capital requirement for total capital. So that gives us a good leeway and leverage to expand. And of course, that what the growth of prospects that the bank is planning for the next couple of years. So we have built enough capital, so we don't have to stress for it or reach out to raise additional capital to seek our growth prospects. In terms of dividends, I think we are very glad to share that we last 2 years, 24 and 25. 24 we have paid 15 rupees full cash dividend, whilst 2025 we have paid cash plus script combined dividend, one of the highest that we have paid, maybe close to the highest in the industry as well among banks. So we will continue to give value to our shareholders. We have recognized the support that they have extended to us, and so also which is reflected in our share price. So in 2025, that to a certain extent reflect the confidence that the shareholders have placed on the stock. So we have seen almost 25% share price growth in 2025, whilst the earning per share has gone up to 83.83 rupees and 23 cents. So net book value per share, the group is increased to 530 rupees a share. And we are hopeful that with the incremental profitability and the solid foundation that we made in 2025, with core banking growth, we are hopeful that we will be able to maintain a similar momentum this year as well. If you look at the DuPont analysis for the group, how this ROE has derived. So from NII, we have seen roughly about 5% coming from with the other income increase. So it's improvised, while impairment cost has reduced the impact on ROA. Operating costs compared to previous year, we have recorded a slight increase, while the taxations we were able to manage better than last year, contributing to the ROA. So leverage multiplier, if you look at, we have maintained just above 8.5, which were close to 9% last year. So we think despite the incremental growth that we have recorded, so that has contributed to the ROE number we have recorded. Moving on to just key highlights, the performance of the bank has contributed by not only one area, there are multiple areas. There are key milestones that we have seen in this journey during last year. So a few of them are listed here, I think, which are very important to note because these sets the foundation of our growth in the next few years to come. So we have collaborated with Visa and we launched a product called HNB Accept, which enable us to drive the financial inclusion across the bottom of the pyramid, where anybody can use their own mobile phone as the POS machine to accept payments. That will drive significant numbers into the digital ecosystem, enabling so them to avail for further finance to grow their businesses. So then we launched transaction banking international trade finance platform, which predominantly supports corporate as well as the growing SMEs in their trade finance requirements. And also on the digital app, we enabled instant cashback loan facility, which has a significant usage since we launched. So that means we believe the initial and the subsequent usage suggests that that has been a need in the market which requires some solution. So I think we provided that solution very conveniently. So we have started opening trade hubs in significant trade transaction locations. We have opened a first trade hub. Then subsequently we have taken to various other places. So we are planning to have about 6 trade hubs established in key locations like the Peta, then Kiribati, Panadura. These are the areas that we are looking at establishing our trade hubs. And we have launched at the high net worth individual category, the first World Elite MasterCard to recognize our elite customer segment. Then we enable card-based payments on expressway toll gates, all the outlets, so that facilitated using credit card, which was a need that was there to be addressed. So HNB was awarded that contract, which we will be using it for 5 years exclusively to support digitizing payments across expressways. Then we were the first bank. We started last year, April. It's almost an year now. So we have eliminated merchant discount rates on Lanka QR transactions. That means we are charged 0% for a transaction value up to 10,000. So that has driven a lot of merchants who are doing small businesses to come into the digital ecosystem and grow their businesses. Also, to accelerate SME digital adoption, we have launched a nationwide mini POS rollout. So that also supports SMEs to come into this ecosystem and increase their business reach. And we have integrated GovPay and the traffic fine settlement systems to HNB app and the digital banking platform, and also Solo, so that anybody who want to avail for services, they can use HNB app and avail any government services. And in case if you got fined, you can pay the traffic fines via our digital apps. So we have conducted the sustained bond issue, so which was a success, oversubscribed on the launch day. So we believe our sustainability related activities will take completely different turn from the 2026 onwards, with specific focus that we have put on the sustainability activities with the appointment of the Chief Sustainability Officer and creating specialty vertical who will drive sustainability related activities as a DNA of HNB. We also launched a 24/7 flagship branch at the City of Dreams, which facilitated a lot of foreign currency transactions. Plus, so we have been the banker for that ecosystem, which is created within the City of Dreams. So with all that, so we have been recognized locally and internationally with multiple awards. So the best one being we were selected as the best bank in Sri Lanka by the Banker magazine UK. So we call it the Bracken Award. So we last won in 2017. So we were honored to receive that award in 2025, which was awarded in London. We were recognized as among the top 1,000 banks in the world, once again by the Banker magazine UK. We were judged the strongest bank in Sri Lanka by the Asian Banker for 2025, which was last won by HNB in 2019. Also, we were awarded the best corporate citizen sustainability by the Ceylon Chamber of Commerce, and we were also chosen as the best retail bank in Sri Lanka for the 16th year, which we believe it's a great stint. It's not easy to be the best for 16 years, and we managed to do it. And for the first time, we were selected as a best bank for large corporates by Euromoney, and also we were among the top 10 best employers for 2025, chosen by the EFC National Best Employer Awards. After 2007, so we were selected and we were conferred as a super brand status in 2025 by Global Super Brands. Of course, with the individual accolade coming for the CEO as a best CEO, having recognized the bank with multiple international accolades. We think the real hard work that put in by the teams and the HNB, and also the real contribution that we made to the national economic growth and the transition has given all these recognition to the bank, and we will continue to support that national agenda, bring country's growth and inclusivity among the SMEs, and we will expose as much as possible to appropriate markets for drive export businesses, as well as creating that productive manufacturing ecosystem. So that brings me to the end of my presentation. I think now we can lead into the next section. Bimal, I will hand over to you to take over the questions.
Thank you, Damit. We move on to the Q&A. The first question is on the HNB Investment Bank, which we consolidated our ownership over the last financial year. The question is about, can you comment a bit about how HNB Investment Bank has performed as a fully owned subsidiary during 2025?
So it's a good question. Actually, we acquired that in January 2025. So we have seen, so one of the basic premise of acquiring the 100% ownership of the investment bank is we have seen with a lot of opportunity in the market, especially in the capital market support growth, plus tightening regulatory requirements where single borrower limits are tightened by the regulator. So then the large corporate require support outside the banking system to continue their economic activity that's supporting the country's economic growth. So it has performed better. It has performed as what we have anticipated, especially in terms of with the capital markets and the equity markets movements that we have seen across. It was able to capture the share of market that we were planning when the interest rates were moving the right way. the HNB securities within the HNB investment banking group made real business sense to us in terms of the decision that we have made. And also, so we have moved into the real core investment banking function of providing advisory and especially on the M&A and also corporate finance activities that we have come through the market. I believe it has been a good addition to HNB portfolio. We have better plans for that as well. So we will continue to grow that and we'll continue to strengthen that the proposition that we have acquired in 2025.
The next question is on the loan book growth. The question is, what proportion of loan growth can be attributed for capacity expansion versus working capital? There's a follow-up question. Has there been a slowdown over the last couple of months in the capacity expansion related credits, or is the run rate picking up?
So last year, credit growth predominantly came from working capital. So I would say maybe good 2/3 came from working capital, maybe 1/3 moving to capacity expansion. So rightfully so, with the dollar rupee being depreciated from 200 to 370 at some point. So when the manufacturing plants are operating at a lower capacity, for them to run up to the capacity that they would have the capability to run with, their working capital increase was disproportionate. So then it got financed over a period of time. So 25 we have probably maybe the peak of it, but maybe towards the second half we have seen the request and the demands for capacity expansions as well. But last month, maybe last week of November and the last month, due to the impact of Ditwa, maybe it would have got diluted a little bit, but we are seeing until the 28th of February event unfolded, we have seen the conversations and the plans for capacity expansions, but maybe this year we might have to wait and see how things unfold given the latest developments that we are seeing.
So there are two questions on impairment. Basically, what are the expectations for the impairment charges for 2026? And the follow-up question is, does the bank consider the current stage 3 provision coverage level sufficient? Another you want to take on?
So in 2026, with the global events that are unfolding, there would be certain overlays and impairment charges are expected to come through. But overall, in terms of the provision coverage, we do not expect a significant deviation from the current levels that we've recorded.
Next question is on the growth outlook. Are you noticing a slowdown in credit or in new inquiries as a spillover result of the Middle East crisis? If not already seen, do you expect it to change in the next quarter?
I think it's too early to say whether we are seeing slowdown in inquiries as a spillover effect of the Middle Eastern crisis that we are seeing. Obviously, it is going to impact the country in multiple ways, and it is well known, what ways that the country will going to get impacted in terms of tourism, in terms of remittances, in terms of energy, in terms of raw materials, in terms of fertilizer. So that all remains at this moment very fluid. But that's why I would say that it's too early to comment. But what we anticipate is that we will start to see that impact over the next quarter, and most likely we would expect maybe the demand for credit will slow down and people will adopt an approach of wait and see what is the next strategy. So maybe after the new year we can see which way the demand is moving.
There's a question on the housing loan book. housing loan portfolio growth, what would be the mix between apartments, new developments, and the houses? What is the bank's view on the condominium sector with new supply coming in?
So in terms of housing loan portfolio mix, majority of the, I don't have the exact percentage at the moment, but the majority of our housing loan portfolio are not apartments. So those are dwellings, because we have a housing portfolio across the country, not concentrated as a percentage of the portfolio in apartment located townships. So it's fair to say that majority would be on dwellings, maybe some part of that portfolio, maybe around 20-30% could be on apartments. On view on the condominium sector, we have seen demand was surging last year. There was a lack of supply as well, but that all the shift in the funds to the asset class real estates have closely being associated with the macroeconomic factors. So we see with investments are flowing or capital flowing from market to market, there can be still demand for apartments and the condominiums with new supply coming in. But if you look at only the local demand, we would expect some level of those are getting slowed down over the next couple of quarters.
The next question is on NIM. Net interest margin declined from 4.86 to 4.26 in FY25. Could you elaborate on the key drivers behind this compression, particularly the impact of asset repricing, funding cost dynamics, and changes in asset mix? There's a follow-up question. Additionally, how should we think about new NIM trajectory and stabilization levels heading into FY26?
So in terms of net interest margin from 24 to 25, yes, there was a contraction. In terms of repricing from interest expense side, we gained, as well as asset book with the quantum expanding. There was no offset in terms of interest income. But from the investment side, that is on investment portfolio, the impact, price variance, impact of a price variance was significantly higher. So that did contribute to the contraction in the NIMs. So in terms of 2026, we would expect a slight contraction in terms of NIMs as of now.
Maybe if I can add on to that, on the asset mix, if you take the investment portfolio, the absolute quantum of the investment portfolio actually came down in the year 2025. So the mix between investments and the loan portfolio, it was more towards loans in the 2025. So some of the growth that we saw on the loan book side was actually funded by the liquidity, from the maturing treasury investments. So that resulted in the decline in the investment portfolio. But on the overall loan book, if we can, take the three main business verticals, the wholesale banking to SME to retail, about 55% of our book is comprised of wholesale banking, which has the large corporates to emerging corporates to the project financing. That 55% composition did not change over the period. And, retail takes about 25%, and that hasn't changed from the beginning of the year to the end of the year. And SMEs kept at 20%. So although we saw robust growth in loan book, there was no concentration in any single portfolio, so the composition remained the same when you compare it to the beginning of the year to the end. But the change in the portfolio was more from assets, some assets moving from investments to loans. There's a question again on the corporate book. If you look at corporate lending for December quarter, how much would that be for capex versus working capital?
I think majority is for working capital purposes, but we have seen a better proportion than what we have seen in first half, in the second half, including the December quarter. I would say maybe a good 80% for working capital and maybe for 20% for capacity expansion.
What are the key cost control priorities for FY26? Should we expect the cost to income ratio to improve meaningfully and over what time frame?
So cost is a concern. So in a year where we will see once again compression in potential expansion due to external factors, while the Sri Lankan market has stabilized and growth trajectory has reasonably established. Now we are once again burdened with externalities. So then we will face challenges due to those external factors to grow as much as what we wanted. So one of the ways that we can look at maintaining profitability as well as stakeholder value is you need to prioritize some of the cost controls. I would say cost optimization than controls in terms of what we can do and within our control. In a bank or a financial institution, there is a significant component of costs which are not within the purview or control of the institution itself, which are maybe statutory, regulatory, and kind of related activities which we are compelled to incur. But out of the costs that are within the control of the institution and our purview, what we are prioritizing is any costs that we incur to generate revenue, we will prioritize it. Any costs that will not contribute to increase generating revenue in 2026, we will deprioritize it. That doesn't mean that we are going to curtail investments or going to curtail expenses, but only we will do is we will reprioritize the activities and expenses which can bring revenue growth within the year. Otherwise, we will continue to do normal business as usual, especially in terms of IT-related expenses. We will go as planned. We have no plan to deprioritize or reprioritize IT-related expenses because we have just launched a 5-year strategic plan, which will enable bank to drive its direction of growth in the next 5 years. So whatever that is related to that strategic plan, we will continue to invest.
The next question is on I think it's on the ADR. What are the bank expectations on ADR for 2026?
So ADR for 26, we would expect it to remain at current levels, if at all slightly, maybe a slight increase. So wouldn't expect a major change from what we've noted in 2025.
There's another question. I think we've answered this already. Whether we've seen a slowdown in the disbursement for capacity expansion due to the current situation. I think Amit responded to this. It's too early to comment. Of course, we are seeing increased requests coming for higher working capital. I mean, we expect that to continue at least in the short term, given all the revisions to energy prices, slight depreciation that we've seen in the rupee and high import cost, devalued rupee will increase the working capital requirements for local corporates. So That trend, at least in the short term, we're going to see. But for capacity expansion, whether people are slowing down their capex plans, that's too early to come in. The next question is on the investment portfolio. Is there any high yielding or are there any high yielding bonds set to expire this year, which could have a downward pressure on NIMs?
So in terms of bonds, there are bond maturities for this year also. But if we look at our investment book, we are not we are more towards treasury bills. So with whatever the maturities that are expected to come in this year, anyway, with the anticipated loan growth, we would expect those to be neutralized.
There's a question on the sector exposure. What is the bank's direct exposure to construction sector? How do you see the growth in this segment? We had a slide on the sector-wise exposure.
Correct. So if you look at construction sector exposure, it is around 17% for the bank of the total loan book, which is about 1.5 trillion. So we have seen construction sector actually is picking up. It was for a couple of years ago. Having said that, because some of the projects, larger projects have started, but it was gathering the momentum. Our future view is that this industry will pick up. However, the external factors will put the material costs high, especially steel and cement. So that will pose some level of challenges, and also other imports that are being required for the industry. So that will, to a certain extent, dampen the build-up momentum to recovery of this particular industry segment, which was lagged other industries actually in terms of recovery. So it would further dampen a little bit, which will make it slower than what is originally anticipated for the recovery.
That's all the questions we have received so far. I think maybe we can wait for a couple of minutes to see whether there are any more questions. We can wrap up this session otherwise. Yeah. With that, we would like to conclude the session. We thank all the analysts, the investor community who joined us on this investor call, and looking forward to engage with you at our future earnings calls. Thank you.
Thank you very much.